Hate the idea of writing a six-figure check to the IRS when you sell a property? There is a legal way to push that tax bill down there. It's called a 1031 exchange. Here's the deal. You sell an investment or a business property. Normally, you pay capital gain tax and depreciation recapture both. But with a 1031 exchange, you can defer both. You can roll the sale into a new property. Your money keeps working. That's the big picture. So, question is, who qualifies for that? This is for property held for business or investment. So, not your primary residence, not for your home. This is not for the place you're vacation in or use personally. It must be real property to real property. So after the 2017 tax law, the TCJA, personal property does not count. That's only think about land building, commercial units, rental units. Those are the only qualified property for this kind of strategy. So let's walk through the steps. Here's how it works in plain English. Step one, you line up qualifying intermediary. We call it QI. So do that before you close the sale. Think firms like Atlas 1031 or one of these services that reputable services you can find in Google. Step two, you sell the property. The cash doesn't touch your bank account. It parks with the intermediary. Step three, you identify what you plan to buy in writing. Step four, you close on the replacement property. The intermediary wires the funds, and that's the flow. Now, there are two deadlines matter. You have 45 days from the sale to identify the replacement property. You have 180 days from the sale to close on it. So miss either one and the exchange fails, taxes wake up, and you got into trouble. So set reminders on day one just to make sure that you keep those deadlines on your calendar. Okay, here are the three things that you should aim for in these transactions. You aim for buying equal or greater value, reinvest all your net proceeds, replace the debt that you paid off, or add cash to cover it. Because anytime you pull any cash out of that deal, that part become taxable right away. It's called cash boot. So the rules are simple but strict. Okay, let's talk about the identification rules. And let's keep it simple. Most people use the three property rule. So you name up to three properties. Be specific, have the addresses, unit numbers, no vague descriptions, keep the proper trail tight with your qualified intermediary. And here's some common pitfalls that we've seen over the years. For example, people sometimes just touch the money. Touching the money is a big no-no that just make the transaction fails right away. Missing the 45 days or 180 days deadline, that's a big mistake. Changing who holds them, during the transaction without planning, the buyer or the seller. Trying to change flipping property, during the transaction in the last minute. Well, remember, these are for investment or business use, not for a quick inventory. So this strategy doesn't work for flipping properties. And also remember to loop in your CPA before you sign those creative structures, because any small tweaks during a transaction can really break the exchange. Now you also have to think about cost versus value. So yes, there are qualified intermediary costs and fees. You may have to pay fees to your attorneys or CPAs or advisors. So compare that to writing a big check to the IRS today. So if your plan is to keep investing, the math usually favor the exchange. You keep your capital compounding instead of paying taxes now. So picture this. I want to put that timeline in your head to keep it clear. So day zero, you close the sale. The fund parks with the QI. Day one to day 45, you identify the replacement property in writing. Now, day 46 to day 180, you start doing your due diligence and close. Day 180, you're done. There is no more activities. The tax is deferred, capital gain still working. Now, make sure the title and finances bases are covered. We've seen that so many times. So keep the same taxpayer on the escrow statement from sale to purchase. Make sure the name of the taxpayer is the same. So if ABC LLC sells, ABC LLC should also be the buyer. So if you had debt on the old property, you need to replace it or add cash. Make sure it's the same taxpayer on both the purchase escrow statement and the seller escrow statement. So tell your lender and closing team it's a 1031 exchange so you wouldn't have any surprise on closing day. And did you know that you can use this as a lifetime strategy? You can swap until you drop. You can do 1031 exchange again and again. You trade up, you reposition, rebalance, keep deferring. And if you still hold those properties when you pass, current law gives your heir a step up in basis. In plain English, those lifetime capital gains can disappear for income tax purposes at death, and that results in that you may never pay a dime in capital gain taxes during lifetime, and your heirs often wouldn't either on their past gains. On the other hand, estate taxes can still apply because estate tax rules vary in every state. So you may want to consult with your estate tax attorney. So we get this question, all the time. So when should I start when I'm thinking about doing 1031 exchange? Early. You call your qualified intermediary as soon as you are thinking about selling or exchanging. Put exchange language in your sale contract. Loop in your CPA to confirm your entity, your timing. You look at your recapture depreciation, your capital gain, and your debt plan. If you're moving pieces inside your LLC or partnership, bring your attorney in too, because clean setup can save you a lot of headache and money down the road. So here's the final reminders. Don't touch the money. Respect the 45 days and 180 days deadlines. Match the taxpayers from sale to purchase. Replace value, proceeds, and debts. Document everything in writing and keep your team talking. This is a great strategy and it matters because by doing this, you have control, you keep more cash in the deal, you upgrade assets, you grow cash flow, and you build wealth without a tax speed pump. That's the traditional 1031 exchange. Straightforward if you respect the rules. Next up, I will flip the script. What if you find the perfect building before you sell? That's what we call reverse 1031. And if you save the deal in the tight market, that really can save you a lot of taxes. So if you hit subscribe, I want to thank you so much for watching this one and make sure you don't miss the next video.
This has been another episode of our tax saving video series. If you enjoyed this video, please like it, subscribe below, and share with other business owners. You can find previous episodes and more information at www.bostacpa.com. Thanks for listening and have a great day.